Welcome back to the Game of Life. In this video, we are going to look at if it's 2008 all over again. Is it possible that your money is safe in banks? It's a question that's been asked more and more recently. In today's video, we're going to dive deep into the history of bank failures, explore how credit card debt, mortgage loans, and skyrocketing government spending in the US track the misleading statements made by key financial leaders like the Federal Reserve Chair and Treasury Secretary before those crises hit. We'll also look at the recent claims about inflation being transitory and a strong economy, and how those statements crumbled under reality. Finally, we'll explore what these patterns tell us about 2025. So stick around, you won't want to miss this. But before we begin, as we preach, our goal is to give you so much value that you feel compelled to give back. All we ask in return is that you subscribe to our channel if you haven't already and activate those crazy notifications. Let's start with the 2008 financial crisis, a time when banks collapsed and the global economy nearly followed. Just before the crisis, both Federal Reserve Chair Ben Bernanke and Treasury Secretary Henry Paulson were optimistic. Bernanke famously stated in March 2007 that the impact of the subprime market will be contained. But just over a year later, Lehman Brothers collapsed, and the subprime mortgage crisis triggered a global meltdown. The Treasury and Federal Reserve underestimated the risk. Banks like Lehman, Bear Stearns, and even AIG were on the brink of collapse due to bad loans, yet many financial leaders reassured the public that everything was under control. Days before Lehman's failure, Paulson was still saying the economy was strong. This left many people unprepared for the catastrophe. Key point: what can we learn from 2008? Leaders tend to downplay financial risks to maintain public confidence. This over-optimism is a recurring theme, which means we need to critically evaluate what we're being told. Since 2008, the financial system has been safer due to reforms like the Dodd-Frank Act, which increased capital requirements for banks. But even in the post-2008 world, we've seen banks fail. Think of Washington Mutual, IndyMac, and others that couldn't withstand the pressure. While we haven't had a collapse on the scale of 2008, smaller banks have still fallen, and the global financial system remains interconnected and fragile. Key point: bank collapses tend to come with little warning. Public statements from financial leaders are often more optimistic than the reality on the ground, which is why it's crucial to look at the underlying numbers, debt levels, bank liquidity, and market trends to gauge safety. Recent economic claims that failed, strong economy, and transient inflation. Fast forward to 2021. Remember when the Federal Reserve, under Chair Jerome Powell, assured us that inflation was transitory? For months, Powell and Treasury Secretary Janet Yellen repeated this narrative, despite growing concerns. The idea was that the inflation surge was temporary and driven by supply chain disruptions due to the pandemic. However, by 2022, it was clear that inflation was not transitory. It kept rising, and central banks were forced to hike interest rates aggressively to slow it down. What started as a temporary issue turned into a long-term economic challenge that hit everyone's pocket. Another example was the claim that the US economy was strong going into 2022. In reality, inflation was eroding wages, and the stock market was extremely volatile. The disconnect between these optimistic public statements and the actual economic situation has created a lot of confusion and mistrust among the public. Key point: once again, financial leaders provided misleading reassurances. The lesson here? Even when leaders claim everything is under control, the reality might be very different. Blind trust in official statements can be costly. A growing risk? The credit card debt, a growing concern for the US state economy. As of 2024, credit card debt has reached over $1 trillion. With high interest rates, many Americans are struggling to make even the minimum payments. When consumers fall behind on their credit card bills, it's not just their personal finances at risk, it can also affect the banks. Banks rely heavily on credit card payments as a steady source of income. When too many people default on their payments, banks take a hit. If this trend continues, it could put pressure on financial institutions, especially those heavily involved in consumer lending. Key point: rising credit card debt increases the risk of defaults, putting stress on banks and making it crucial for you to monitor where you keep your money. A new housing bubble. Next, let's look at mortgage loans. The housing market in the US has seen rapid price increases over the last few years, driven by low interest rates and high demand. But now, with rising interest rates, some homeowners are struggling to afford their mortgages. In the 2008 financial crisis, we saw what happens when mortgage debt spirals out of control. Banks were heavily exposed to bad loans, and the ripple effects nearly collapsed the global financial system. Today, while banks are better capitalized, they still hold significant mortgage debt. The real question is, will rising interest rates and potential defaults trigger a similar collapse? The answer isn't clear, but the risks are mounting. Key point: if defaults in the mortgage market increase, banks could be in trouble again, raising concerns about the safety of your money. Government spending and debt. Furthermore, let's talk about government spending and debt. The U.S. national debt has surpassed $33 trillion, and government spending is only increasing. What does this mean for banks? Well, it creates a challenging environment for everyone. When government debt is high, interest rates tend to rise, as we've seen recently. This affects everything from mortgages to business loans and even credit card interest rates. When interest rates rise, borrowing becomes more expensive, and many individuals and businesses struggle to pay back their loans. Banks, in turn, face higher risks as defaults increase. Moreover, a government with high debt has less room to bail out struggling banks should another crisis occur. Key point: as government spending continues to spiral, it adds pressure to an already vulnerable financial system. This could pose a risk to your money sitting in the banks. What's ahead in 2025? So, what does all this mean for 2025? If history is any indication, we should be cautious about taking official statements at face value. Today, we're facing a range of economic challenges: rising debt levels, geopolitical instability, and a banking system still vulnerable to shocks. Banks, while more regulated now, are not immune to risks. With rising interest rates and the potential for economic slowdown, even larger banks could be exposed to liquidity risks. Remember, many of the cracks in the system in 2008 started small, and by the time it was obvious, it was too late for most people. Moreover, we're seeing eerily similar patterns in statements from financial leaders today. Many central bankers say inflation is now under control, and some have declared the economy to be resilient. But can we trust these claims? Key point: the lessons from 2008 and recent economic missteps tell us that 2025 could hold significant risks. We must remain vigilant, keep an eye on the real indicators like inflation, debt, and interest rates, and most importantly, be prepared for sudden changes in the financial landscape. Is your money safe in the banks? Now, let's answer the big question. Is your money safe in the banks? The short answer is, it depends. Banks today are much better capitalized than they were in 2008, but the system still has vulnerabilities, especially if there's another shock to the global economy. Your money is protected up to $250,000 by FDIC insurance in the US, but what happens if a larger systemic crisis hits? Banks are only as strong as the financial system supporting them, and with mounting global debts and economic instability, risks remain. One strategy to protect yourself is diversification. Don't keep all your money in one place. Look into other assets like stocks, bonds, or even cryptocurrencies if you're comfortable with higher risks. Another option is precious metals like gold, which historically perform well during financial crises. Key point: while your money is safe in the short term, you should always have a backup plan. Trust the banks, but verify their strength and diversify your assets to ensure financial security. So is your money safe in the banks? The answer is not 100%. The past has shown us that financial leaders can be wrong, and unexpected crises can still occur. With rising credit card debt, increasing mortgage defaults, and runaway government spending, banks are under more pressure than they've been in years. The key is to be prepared, diversify your assets, and stay informed, so you're not caught off guard if things take a turn for the worse. Let me know in the comments, How do you feel about keeping your money in the bank? And what are you doing to protect your financial future? If you found this video helpful, give it a thumbs up, and don't forget to subscribe for more insights into personal finance, economics, and how to safeguard your wealth. Stay tuned for the next video where we'll dive even deeper into strategies for financial protection. Thanks for watching, and please click on the video to my right or left. They are fantastic.